Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about momentum investing, which is a strategy, a rules-based strategy you can use in the share market. But the reason I started thinking about momentum investing is, partly because I wanted to talk about it from a evidence-based share market principle perspective, as well as some other sort of factor investing, but also, and more correctly, I've noticed more recently, and it's probably a long-term common trend, but something I've noticed more recently that it seems to be an approach that a lot of people in the property industry advocating as well. And that's where the caution sort of comes into play, is that you've got to be really, really careful about following that trend, I think, for all the reasons I'm going to talk about today in today's podcast. And down the track, I'm going to, which sort of links in with this subject as well, I would like to record an episode about the last 5 years of data. So really, I'm talking 2020 to 2025, because if people are going to make investment decisions, particularly property investment decisions on the last 5 years of data, they've got to be really careful because the data is quite noisy. A lot of things have occurred over that time, and you need to really consider carefully whether they're going to reoccur in the future. So whether we can extrapolate that trend. It's all interrelated in today's podcast as well. So that I'll talk about that down the track. But let's start by talking about momentum investing. And really, it's a share market strategy that involves buying the stocks with strong momentum, but strong positive price momentum, avoiding the stocks that have, potentially selling the stocks that have strong negative momentum. And so it's really about looking at what stocks have been the winners over the last 6 or 12 months, depending on your strategy, and buy them because they're benefiting from, there's a reason why they're increasing in price and they're benefiting from positive sentiment, and then hold them until the momentum stops, sell and buy the new stocks. And that's what's called a momentum strategy. There's a couple of ETFs around that utilize this strategy, which I'll talk about. I'll share which ETFs they are in a second. Anyway, I want to talk about that. I'm going to talk about what does the evidence show us in the share market. And then what I'd like to do towards the end of today's episode is then talk about property and how does it apply to property. Because the one thing that, and I've mentioned this before in this podcast, is that there's a lot of research and academic analysis, and particularly, and most importantly, peer-reviewed academic research and analysis, because that's kind of important. Because if I come up with a methodology and strategy, much like what I talk about in this podcast, I put it out there and anyone can critique it. And I think that's a really important process to make sure the analysis or the conclusions drawn are robust, and they're tested and so forth. So there's a lot of that in the share market. Of course, there's a couple of reasons for that. Firstly, the analytical approach in the share market, which might be technical analysis or fundamental analysis, all these sorts of things. There's a long history of that, right? And there's a lot of money in that market, and there's a long history behind a lot of firms and a lot of institutions and so forth that have been spending, 60 hours a week analyzing the stock market. Of course, you're going to get better insights in that way. And then also the data is quite reliable. It's very transparent, it's very up to date and so forth, less so on the property front. But I think there's a great opportunity to apply some of the same approaches and learnings that occur in the share market to the property market and try and become a little bit more comprehensive or considered in our analysis of property, and hopefully improve at the end of the day, improve our investment decision making. So before I talk about momentum investing as a strategy by itself, I want to talk about factor investing. And so factor investing uses a systematic, often rules-based approach to select stocks or exclude stocks in a particular index based on certain measurable characteristics. So these characteristics are known as factors, and they're chosen because historical evidence either helps explain lower risk or higher returns over time. And by tilting towards these factors, what investors hope to do is either achieve a higher return and or lower portfolio risk. And of course, this is relative to just the general market cap indexing. So just your traditional indexing, which, arguably has performed well and has performed better than most active fund managers. All the data is there to support that. So we're but this analysis isn't suggesting that we shouldn't do a traditional market cap index anymore or that it's not going to work. What we're trying to do here is look for evidence-based approach to use different methodologies in different markets at different times that better accommodate the risk and opportunities that are present in those markets. So it's not a substitute for traditional market cap indexing. It's in addition to, on a portfolio level, what you're trying to do then is lower risk but higher returns. And the two best examples, or most popular really, examples of factor investing are value and quality. So value targets companies that appear attractively priced relative to their fundamentals. So most importantly, what a value factor does is really exclude the companies in an index that look overvalued. And so they look at, price earnings ratio, but quite often price to book ratios, and measure that relative to the sector and relative to the overall market on a long-term basis. And of course, the investment thesis behind value is really straightforward, that the price you pay for investment largely influences your future returns. Of course, if you pay too much for an asset, of course, it almost always leads to below average returns. And that makes a lot of sense. And I would say that a value approach to investing is probably the best way to reduce your portfolio risk and expose the portfolio to higher returns. And by that, I mean that if you're really disciplined with respect to your investment decision making and you only invest in high quality assets that are cheap, then of course, because I've got this high quality asset, the probability of it not performing is pretty low because of the fundamentals are strong. And because I've paid a cheap price for it, then chances are my returns will be above average. And to my mind, that holds a lot of fundamental weight, and I think it's a great investment strategy. The second most common factor that is used in the share market is the quality factor. And quality sort of refers to investing in the businesses within the index that are the most robust. And how this quality factor might work is it might take any given index and then it'll measure quality. And with respect to quality, the strategy will look at things like low debt, so very strong balance sheets, high historic return on equity, so there's some proven performance in there, reliable and stable cash flow and earnings, so it'll look at dividends and also cash flow and profitability. And it'll use these kind of three measures to ascertain the stock's quality, and then it'll invest in the 100 stocks that are the highest quality by those quantitative measures. Now, it could be a different number, of course, but that's just generally how it looks. And so the quality factor, the thesis behind a quality factor is if I'm investing in very high quality businesses, chances are those high quality businesses will produce high quality returns over the long run. But also, if I'm investing in high quality businesses, they're going to be able to better withstand market downturns or any sort of volatility or changes in sentiment and these sorts of things. So if I'm worried about the market being overvalued, I'll employ a value factor approach. If I'm worried about, what the economy might do in the future, changes to interest rates, economic slowdown, higher unemployment, these sorts of things, then I might employ partly a quality factor in my portfolio to try and protect the portfolio from that potential risk or downside. Now, of course, you're not going to protect it perfectly well. I mean, if the market crashes, the market crashes. Almost everything gets dragged along with it initially, but it's really the recovery that's the most important aspect. So if we go through an economic cycle, a market volatility cycle, let's say the index drops 30% and takes a year to get back to where it was pre-drop, which is not unusual. The question will be, our investments, do they recover in line with that? Do they recover faster and stronger, or do they in fact never recover? So when there's a bit of a clean out from a stock market incident, a volatility incident, sometimes those companies that were wildly overvalued that had no fundamentals will never recover, or certainly not to the level they were before the crash. And the companies that may have been unloved at a time, sometimes the market sentiment shifts and they start to become more loved by the market. And in fact, they recover faster and stronger than what they were before that volatility event. And that's what you're trying to do. You can't avoid the volatility, of course, but what you're trying to do is focus on maximizing medium to long-term returns. And you can use some of these factor investing in order to do that. And we use both value and quality, by the way. They're both included in our portfolios. And I'm not saying every value ETF or every quality ETF is worth investing in. They're all very different. You need to have the knowledge to work out how you're going to incorporate them in portfolios and to what extent. But really, just to frame or to give you a bit of a background on factor investing, because we're going to talk about momentum investing, it's important that you understand what I'm sort of talking about. Now, the thing is, though, that there's a lot of factor strategies. So I talked about value and quality, and value and quality are really rooted in deep academic research. So no one's going to argue that those qualities, or very few people will argue those factor approaches aren't fundamentally sound. They are, and they're the most popular. But there's also a lot of other factor strategies out there. And it's really important to work out if there's a factor strategy out there, which ones should you use and which ones should you ignore? Because remember, the people marketing these factor strategies, their goal is to attract your money. That's their only goal. So sometimes it's marketing puffery, rather than investment fundamentals that they're using to try and market these strategies. So it's very much buyer beware, if you like, or investor beware, really. So then how do you know which factors to use? So I want to talk about some of there's 5 things that we tend to think about, we always think about when considering whether to use a particular ETF or particular factor strategy. And we're very, very selective and disciplined about it, by the way. So we would prefer not to use a strategy rather than take the risk and incorporate a new strategy. We really want to make sure that we're going to get the exposure that we think we're going to get, and we're going to get the results that we think we're going to get, and we want to have a high level of confidence with that before we start using a particular ETF. Okay, so let's talk about those 5 things we think about. The first one, it's got to be rooted in fundamentals and logic. So the factor must make economic sense to us. It's not enough that there's some sort of statistical correlation. There needs to be sort of a clear understanding of why a particular characteristic produces either a positive or negative result. So, for example, if I talk about value or quality, it's really clear about why a portfolio might behave it does if it's an index of very high quality assets or an index of very cheap businesses, for instance. Number 2, it's got to be a factor that can be observed across all markets. So again, it builds a really big picture. We don't want to use a strategy that only works in the Australian market and doesn't work in any other market, for instance, because that could be an explanation of just some sort of correlation to data rather than an actual principle. Whereas a really good high-level quality factor, that you should be able to observe that factor in all markets, and that gives you confidence that it's not just an aberration in that particular market that you're looking in. You want to see, number 3, you want to see a long history of performance. So really you want to see how the factor performs over many decades and through many different cycles. So you need to, they're saying in financial services, you've never seen a back test that isn't impressive. Of course, everyone back tests, an index, and back testing really, what that means is it looks at and says, well, if I apply these investing rules over the last 30 years, what would have the results been? And that's called a back test to kind of prove that this is how it would have performed in a particular market, particularly if it's a new factor. Now, of course, they wouldn't publish the back test unless it was, positive. So that's why, of course, every back test you see is going to be positive, but really you want to not necessarily just rely on the ETF provider's analysis. You want to see that peer-reviewed research. You want to see that analysis, and you want to see how that factor is performed in many different cycles. And particularly, you want to see if the factor is underperformed in cycles that you expect it to underperform in, and vice versa. Number 4, you want it to be robust to a reasonable definition. So, for example, if someone's done some research and said that if we buy every stock that is trading at a price to earnings ratio of below 20 times, that this is the best strategy to employ. Now, what you want to do then is say, well, what if we bought stocks at below 21 times or 22 times? That's a little bit more expensive, obviously, than the 20 times benchmark. And so it's reasonable to expect that strategy wouldn't work as well because you're buying companies that aren't as cheap, but it still should work generally. Like even to a lesser extent, it still should give you a positive result. Again, what you want to do is make sure that the strategy works generally and you're just not cherry picking formulas. So you want to be able to play with the formula and dial it up or down, and the result should dial up or down relatively commensurately, just to make sure that correlation there, or that predictive sort of rules-based approach, is robust enough. And finally, the strategy has to be implementable. So that is that the investor must be able to access that factor without excessive trading costs, tax drags, high management fees, all that sort of stuff. At the end of the day, a strategy is no good unless you can actually implement it. And so part of this is really someone will come up with a new factor approach. It might be absolutely sound and you can't find any holes in it, but unless it's actually been implemented in an ETF environment and you've got the history, it's gone through a volatility event, those sorts of things, you never really know how it's going to behave. So you want to see that implementable track record. And so they're the 5 factors that we will look at, excuse the pun, 5 characteristics, I should say, that would look at to make sure that a factor, to start in using a factor in our portfolios. And it's something, as investors, we're bombarded with lots of different products. Beta Shares will come out with a new ETF before I finish this episode, for example, probably. There's literally hundreds of ETFs out there now, and the market's going to become saturated. There's going to be a lot more in the future as well. And not every one of those ETFs, of course, is going to be investment grade. So you just want to make sure that, if you're going to invest in something, I think you want to employ a really robust process to make sure that it's going to be a high quality investment and it has the underlying risk and opportunities that you might think it had initially. They're the 5 factors that we think about. Okay, so I've talked about factor investing. I've talked about how to choose a factor. Now let's round it back to the momentum factor. So as I said at the beginning, the momentum factor is really based on the observation that stocks that have been rising for a while tend to continue rising for at least a little while. Now, I know that there's no massive research around, there's a lot of research, but there's no hard and fast rules around this. But typically, if a stock has risen for the last 6 to 12 months, chances are it'll keep rising for another 6 to 12 months. And in fact, the average time, about 9 months, I think, is what the data tells us, that typically, if you go and buy that stock, you'll hold it for 9 months, and then its momentum will start to wane and it won't be in that high performing anymore. And the theory behind momentum is that the market and investors are slow to absorb new information. So, if there is a new positive or even negative information, sometimes prices just generally drift upwards as the news sort of gradually sinks in. Also, human behavior amplifies the momentum trend as well. So fear of missing out, herd mentality, all these sorts of things. There's a lot of data that shows that money inflows tend to chase returns. So that is, if there's a rising investment, typically more and more money will go into that investment. And there is actually a really interesting study that demonstrates this. So it was Peter Lynch's Fidelity Magellan Fund. Between 1977 and 1990, the fund returned about 29% per annum, but the average investors in the fund lost money. And the reason for that is that anyone that invested in 1977, of course, made a great return and hung on for that entire period. But unfortunately, once Peter Lynch had racked up fantastic returns, that's when most investors joined the fund. So I don't have the data in front of me, but if you had have invested probably in 1985, 5 years before that long-term trend occurred, maybe there was losses in that year. So typically money is late to the party. So how does a momentum strategy work? Well, it's different for every ETF or manager that puts it together. Typically what happens though is what you do is you rank the stocks within an index. So if we're talking about the ASX 200, we'd look at the top 200 stocks. What have their returns been over 6 or 12 months, depending on, the strategy employed, and you would rank them from highest to lowest. So then what you're trying to do is look at, for example, the best performing stocks over the last 6 months. You would usually typically exclude the last month because sometimes there's a bit of a bounce or some noise in the data if you just include what's happened over the last few days. So if we were doing this analysis in October, I would look at, for example, the performance over the 6 months ended end of August, for instance. So ignore September. And then you would buy the top 10 to 25% of stocks. Again, depending on the ETF, everyone uses different rules. But let's say you buy the top 10%. And then every couple of months, you do the same sort of analysis and you work out, what do the top 10% look like now? And what you'll see is some stocks move into that top 10% and some stocks move out of it. So you'd sell those ones that move out of it because they've lost momentum, and then you'd buy the ones that, move into that top 10%. And what tends to happen is you will tend to keep those stocks for 6 to 12 months. So typically that's the length of that momentum cycle. Of course, it can last longer, but that's typically what happens. And, you just keep sort of turning that portfolio over. And there's a perfect current example of how momentum works in the market. All we need to do is look at gold and Bitcoin, which are the two best performing assets, if you like. I don't want to call Bitcoin necessarily an asset class or an asset, but the two best performing investment options over the last 12 months. Gold's up about 50% and Bitcoin's up about 85% over the last 12 months, which is significant and a perfect example of momentum and how the momentum strategy plays out. So of course, momentum sounds like a good strategy, and buying the winners might feel like an exciting and a safe thing to do. And, people might talk about Nvidia and, where will its price go, or, go buy Tesla, where will its price be in the future, and these sorts of things. There's a lot of talk on social media and around dinner tables about sort of momentum investing. But it's really important then to think about, as a strategy, how does it work? Buying what's popular at the moment or what's being popular, how does it really work? Well, actually, in real life terms, the evidence is pretty poor. And the reason for that is, whilst academic research confirms that, that there is a bit of alpha there, that you can outperform just the general market index, the problem is in the implementation and the cost drag associated with higher trading costs and higher taxation outcomes as well. So the trading costs come because there's a high portfolio turnover. And so if you're buying and selling stocks, and particularly if those stocks aren't perfectly liquid, your bid-ask spreads might be a little bit wider than what they will be on very highly liquid stocks. Also, there can be execution delays. So when you rebalance, that can have a big impact. And then, of course, brokerage fees just on the buying and selling. Now, some ETFs design a strategy to kind of reduce portfolio turnover. But if you reduce portfolio turnover, you start to sort of dilute the impact of the momentum factor. The whole momentum factor is hold the stocks that have the strongest momentum at the moment. And if you're not rebalancing and reweighting that index, arguably you're not necessarily doing that. And then secondly, the taxation drag. Of course, if you're going to turn over your whole portfolio in 1 year, your total return is going to be taxable, because each time you're crystallizing a capital gain, often you haven't held that investment for 12 months, so that gain's fully taxable. So even if a momentum strategy delivers 10% per annum, that might look like a good return, but it's most likely mostly taxable as a return, which isn't really very tax effective, of course. So there's been a lot of academic research that demonstrates that will suggest, momentum strategy, you can observe that factor in terms of producing a better return. It's really the actual implementation part where this factor fails. And so if we look to real life then as examples, there's a momentum ETF in the US under the iShares brand name, which is BlackRock. So there's an iShares momentum factor. It's a very large fund, has about 30 billion Australian dollars in it. And if you look over the last decade, the last 10 years, it's underperformed the index, so S&P 500 index, by about 1% over a decade period. So significant underperformance there relative to the broad index. And you would think a momentum strategy over the last 10 years in the US should have worked really well, because there's been, the stocks that have had very high momentum, have driven most of the share market return, to be honest. So it's interesting. In Australia, there's momentum ETF that's only just a little over a year old now, a beta shares ETF. And over the last 12 months, it's beaten the ASX 200 index by an impressive 7%. Now, that's just a 1 year's worth of results. So it's too short a time period to draw any meaningful conclusion from that. But you'd have to say that, there's an overwhelming body of evidence that demonstrates that ETF probably isn't going to outperform over the longer run, even though it's done significantly so over the last last year. So as always, if you want to check out those ETFs, I've got the link on the blog on the website. And of course, the link to the blog is in the show notes on this, wherever you're listening to this podcast. So that's the evidence. So there you go. That's factor investing in the share market, talking about momentum investing, which is really buying what's popular, which is a very common strategy that a lot of, retail investors use just because they're keen to participate and not miss out on returns, even though that Peter Lynch study around fidelity shows that, most people are kind of too late to the party and mess it up. But even if you come up with a very robust momentum factor, based on empirical evidence, and you implement a strategy just like I just explained, it shows that even BlackRock, which is the largest fund manager in the world, over the last 10 years has failed to deliver on that. So if we're investing in the share market, maybe the approach is not to buy what's popular. That's, I think, essentially the conclusion you can draw from that analysis. But using factor-based investing can complement and does complement traditional market cap indexing. Just got to be really selective about which factors you use and when to use them, in particular, when, timing, and where in terms of geographical markets or sectors or industries to use those. Now what I wanted to do is talk about momentum investing when it comes to residential property. Now there's plenty of buyers agents on social media love to highlight short-term success. They will advertise, I bought this property for a client 3 years ago and now it's up 50%. And of course that's a good outcome for the investor. I'm not saying or trying to sell you the idea that, a 50% increase in value over a very relatively short period of time isn't good news for the investor. Of course it is. But is that just random luck? Is it repeatable success? But also, and most importantly, that doesn't necessarily inform you of whether that investor is going to be successful over the long run. Because anyone can go to a casino, for instance, and put all their money on black and double their money and walk away. Of course, that's a possible outcome, but is it a repeatable strategy? And will it do what we want it to do over many, many decades? Now, we know that if the buying and selling of investments on a regular basis eliminates any benefit, any alpha, any additional return in the share market, just like the momentum strategy that I just gave you an example of, both on theoretical and real life, then you can definitely, absolutely assume that those transactional costs are going to kill any additional returns in the property market, because the entry and exit costs are much, much higher than what they are in the share market. So therefore, we know it's not going to be a repeatable strategy. We can't repeat this strategy with absolute accuracy and consistency if we're going to only invest a very short period of time. So we can't invest in property and have a 5-year time horizon, for example. If we could, then maybe those posts by on social media would be worthwhile, but we know it's not about that. The key to success with property investing is the highest average return over multiple decades. And the reason for that is that holding a property for multiple decades allows you to benefit from compounding capital growth. And so what I'm mostly interested or only interested in is what will the average growth return be over 10, 20, and 30 years. And if I can invest in an asset that's going to have an average growth of 7% over a 30-year period, I know that property is going to double 3 times over that 30-year period. And that's what's going to do all the heavy lifting in terms of building wealth. So what I'd love to see is buyers agents advertising 10 or 20-year returns. This client just sold this property I bought for them 15 years ago, and this is what the return will be. That's what I would be really excited about, because that would suggest to me that if the buyer's agent had done that a number of times, like for all their clients, if you like, that builds a strong body of evidence that that buyer's agent knows what they're doing. If they're just going to get off the back of some momentum and start buying in an area that's already moving with strong momentum, particularly even if it's artificially generated, a lot of buyer's agents buy the same sort of data reports, if you like. And as a result of selling those data reports, those particular hotspots, if you like, start to generate or enjoy strong price momentum. And so one strategy would be, well, let's just go and buy in that area where there is strong price momentum. And 3 years later, the client's gets really happy and they'll buy another property and you generate another fee. And as a strategy, that works in the short term, but it's not really, or it's not always going to generate great long-term returns. And that's really where the benefits are. So there's really two takeaways I'd like to leave you with today's episode. One in the share market and one in the property market. The first one in the share market is be really careful and discerning about which factors you use in share market investing in ETFs. You want to be really highly selective which factors you use, which fund managers you trust to implement those factors, when you invest in those factors, and in which geographical markets will you apply the different factors to. An ETF manager's job is to tell you a compelling story, all the good news if you like, but your job as an investor is to wade through all that marketing puffery if you like, look for the sound fundamentals and look for a strategy that's backed by solid evidence and solid history in terms of implementation, not all the marketing spin. And the second thing I'd like to leave you with respect to property is don't be dazzled by recent returns. In fact, in my earlier research earlier this year, I looked at the growth cycles and the flat cycles in the property market since 1980. So, last 45 years of data, and it showed that the average cycle the growth cycle lasts around 10 years. Therefore, the ideal strategy is to really buy an investment grade property either before that cycle begins or only just a few years after it starts. And that'll help you capture those above average returns, certainly in the shorter term, say over the first decade. But by definition, this means we're usually going to be investing in a geographical location that doesn't have above average returns over the last decade. For instance, if you look at Melbourne, it's grown at 3%, so grown in line with inflation over the last decade. That's a terrible return. Whereas it might sound more exciting if we say, let's go invest in Adelaide. It's grown at 7.5% over the last decade. Does that make you feel any better? Absolutely not. I think in property, it's the reverse of a momentum strategy. Invest in the markets that have the least amount of momentum for the longest period of time. Chances are you're going to buy a property, an investment grade property, below its intrinsic value. And secondly, you'll benefit from that mean reversion, that principle or trend that returns always revert to their long-term average or mean. So if we remind ourselves of those two evidence-based rules, I think that'll be really valuable in helping us make future investment decisions. Okay, a little over time today, no time for questions, but until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.